Hey everybody, today we'll discuss Business and Contract Law Week 13, and this week's topic is banking. Let's begin. So we started with last week. We discussed property law, types of property and property ownership rights. And this week we are going to discuss banking, creditors' right, and bankruptcy, understanding financial institutions and consumer protections. Agenda will be first is introduction, and then we'll talk about financial institutions. After that, type of loan, debt insurance, consumer protection in banking, bankruptcy overview, creditors' right, loan default and remedies, financial risk management, banking regulations, case studies in banking and creditors' right, conclusion and recommendations. Yeah. Introduction of banking and creditors' right sets the foundation for understanding the financial landscape. Banking services play a crucial role in the economy by providing necessary financial tools, while creditors' right protects lenders and creditors from default situations. Consumer protection measures are essential to maintain trust and integrity in the banking sector, fostering a fair and secure financial environment for all stakeholders. Financial institutions play a vital role in the financial ecosystem by providing essential services such as deposit taking, lending, wealth management, and insurance. These institutions operate under a strict regulatory framework to maintain financial stability and protect the interests of customers and the economy. Understanding the types, functions, and regulations of financial institutions is crucial for effective financial management and oversight.
Did you know that at least 5% of adults in America don't have a bank account? That means that they're storing their hard earned money in a piggy bank, under a mattress, or uh, whatever that's called.
This is our secret spot. It's very secure.
Are you sure?
Yep, totally.
Well, most individuals and businesses store their money with a financial institution for safekeeping. They deposit it in and withdraw it out whenever they need. Have you considered using a bank or a credit union?
What's the difference?
Banks help protect your deposits from fraud and theft and offer access to all kinds of services, like lots of branch and ATM locations, online banking, special accounts, credit and debit cards, and even big loans for cars, houses, or starting a business. They're for profit and make their money mainly through various service fees and the interest charged on loans. Credit unions are similar to banks, but are usually exclusive to specific regions or industries, like firefighters, teachers, or farmers. Unlike banks, credit unions are generally non-profit, so they tend to have fewer products beyond the basic accounts, cards, and loans. But since they aren't under pressure to make a profit, they're able to offer their members a better deal when it comes to fees and interest rates.
Are both banks and credit unions safe?
Like anything in life, there's never no risk. But government regulations set important rules for financial institutions, which helps make them more trustworthy. And even if your deposits are somehow impacted by theft or loss, or NCUA. This all
Okay, so it was a small interruption for internet.
dependable banking system, which means your money is better protected and easier to manage. That's something Mr. Piggy just doesn't offer. Sorry. Almost every financial institution offers checking accounts and saving accounts. A checking account is where your deposits and withdrawals generally happen. Sometimes there's a minimum deposit requirement. A savings account is for, you guessed it, saving your money. Usually you earn a little extra money in this account thanks to interest, but you may be limited in how often you can make withdrawals. Credit unions tend to pay higher interest rates than banks into your savings account. Additionally, most employers are able to directly deposit your paycheck into your bank or credit union account. That saves you the trouble of having to manage the cash or check yourself. For simple account needs like deposits and withdrawals, you don't have to wait in a long line during banking hours. Automated teller machines, or ATMs, are convenient ways for you to access your account on your own at any time. Banks tend to have more ATMs and more locations than credit unions.
So, do I need to withdraw cash every time I go shopping?
Nope. Once you've got an account, you'll probably get a debit card. These handy little cards link directly to your checking account and allow you to pay for things using the money that you have available without having to actually carry the cash. Spending more than what you have in your account will result in penalty fees, though, so be careful.
All right. How do we get started?
First, determine your financial needs. If you need access to more locations and ATMs, or you like doing your money management online, then a bank may be better for you. If your needs are pretty basic and you prefer better rates and more personalized customer service, then a credit union may be your best choice. Second, get the details. Once you've picked your financial institution, make sure you understand any fees, limits, or perks that come with the account you want to open or cards you want to use. This will help you manage your money more carefully and avoid surprises. Third, manage and monitor. Take advantage of any helpful money management tools or advisors that your financial institution makes available to you. Keep an eye on your accounts, and if you see any suspicious activity, notify someone at your bank or credit union. That's why your money is there, so they can help you protect it. Choosing what financial institution best fits your needs is a personal decision, and when you find that right fit, you'll be able to manage your money with greater convenience and have confidence that a bank or credit union is keeping it safe for you. Watch more at PragerUkids.com. And parents,
Now let's understand type of loans. It is essential for us as individuals or businesses to seek financial assistance. Secured loans offer lower risk for lenders due to collateral requirement, while unsecured loans provide stability for borrowers but may involve greater financial responsibility. Terms and conditions for loan state the repayment structure and legal obligations, influencing the overall financial health of borrowers and lenders. So now let's try to understand overview of loan type. Loans can be classified into various types such as personal loans, mortgage loans, and business loans, each designated to meet specific borrowing needs and purposes. Secured versus unsecured loans. Secured loans are backed by collateral, providing lenders with security. For example, if you are buying home loan, so home loan like mortgage is backed by your home itself. Your home is not your home unless you pay completely full amount to the bank. Unsecured loans do not require any collateral but may have higher interest rate to mitigate their risks.
Loans are when one party gives money to another party in exchange for that amount to be repaid, usually with interest. They can help borrowers out of a bind, assist borrowers in purchasing expensive items, or advancing their careers, or may even be used by unscrupulous lenders to take advantage of the desperate. Understanding the basic types of loans can help borrowers recognize which ones are appropriate and can even help them get better deals. In this video, we'll go over the basics behind nearly every type of loan, most of which fall under consumer loan options, small business loan options, and crowdsourcing and other non-traditional loan sources. And check below in the video description where we will note the times for certain sections if you want to skip to specific types of loans. First, let's cover consumer loan options, starting with personal loans. Personal loans from institutions. Personal loans are a common way for consumers to get money from banks or credit unions. The money is paid in a lump sum and is paid back over a set amount of time. Personal loans from friends or relatives. Asking a family member or friend for a loan is another common way to get money, and a more formal document like a family loan agreement can help minimize the risk of relationship damage from a family loan or an IOU gone wrong. We have free templates for these available at the link in the description below this video. Payday loans. Payday lenders loan money to people by letting them borrow against an upcoming paycheck. Despite attempts to regulate payday lenders, they can still charge exorbitant fees that wind up being multiple times the value of the loan if the borrower can't repay them quickly. Also falling under consumer loans are auto-based loans. Auto loans. An auto loan is a loan specifically for the purchase of a vehicle where the vehicle itself is used as collateral for the loan. This means that the lender can repossess the vehicle if the borrower falls behind on their payments. Car title loans. A car title loan puts the title of the vehicle up as collateral for the loan, which means that the lender can take the car if the borrower does not repay the loan on time. Because of the high fees and the short terms, they usually wind up being not a very good deal for the borrower. Much like car loans, there are several consumer options for home-based loans, like mortgages. The mortgage loan is the most common method for people to purchase a home. The lender provides the funding for the purchase of the home, which the borrower agrees to pay back over a certain period of time. Home equity loans are a lump sum loan that is repaid over fixed monthly payments that is based on how much money you have put into paying off your mortgage. Typically, a home equity loan will allow you to borrow up to 85% of the equity in your home. Like a mortgage, the home equity loan uses your home as collateral and can take your home if you default on the loan. Reverse mortgages are a type of home equity loan where the bank pays a homeowner age 62 or older a set monthly amount based on the equity built up in their home. These payments continue until the homeowner dies, sells the home, or moves away. At that point, the loan is repaid either by the bank taking the home or by the loan being repaid in full. Next up, credit-based loans. Credit cards are a common credit-based loan. Each month, the borrower can borrow up to the limit set on the credit card and pay it off without interest. If the month passes and there is still debt, then the borrower is charged interest on the debt. A personal line of credit is like a credit card, just without the card. Like a personal loan, a line of credit allows the borrower to receive a certain amount of money. However, like a credit card, the line of credit remains open once the borrower has paid it off, allowing the borrower to use it whenever it is needed. A home equity line of credit is like a home equity loan that the borrower can use whenever they need extra cash. Provided that it is paid off within the allotted time, it's essentially like a personal line of credit, but it uses your home equity as collateral to secure the loan. Student loans. A student loan is a loan that a student takes out in order to pay for higher education. Unlike a personal loan, student loans are generally meant to be for school or school-related items such as books, housing, food, and transportation costs incurred while going to school. The federal government subsidizes loans for students who meet certain requirements, while other students who don't qualify choose between unsubsidized federal loans and private loans. Next up are small business loans. In addition to consumer loans, there are an entire class of loans dedicated to entrepreneurs and small business owners to help them make capital improvements, manage economic uncertainty, and accelerate growth. Many of these tools are similar to their consumer counterparts, but structured with business owners in mind. Business line of credit. Just as consumers can secure a line of credit to help them handle unexpected financial hurdles, so too can many small business owners. Business owners can get a line of credit, giving them anywhere from $1,000 to $500,000 to help them manage their businesses, with rates that usually range from 8 to 24%. Business credit cards usually have a higher interest rate than business lines of credit, but they incentivize business owners to choose them by giving them greater flexibility as well as access to various rewards programs that could give business owners who use them responsibly a healthy boost. Business term loans. Think of this as the de facto type of loan for most small business owners. Structured like a personal loan, the business term loan allows a business owner to borrow up to $2 million and then pay that money back over the period of 1 to 5 years. Business term loans generally have very attractive rates. Short-term loans are like the standard business term loan, but as the name implies, they usually get paid off over 1 to 3 years. They have slightly higher interest rates, but they are built for speed. Equipment financing loan. Equipment financing loans are created for the express purpose of purchasing or replacing equipment. Because of this, they have a fast turnaround and require less extensive documentation. Despite that, equipment loans have limits of up to $5 million for businesses to purchase the vital but sometimes pricey tools that they need to make their business run. Accounts receivable financing loan. This is something akin to a payday loan for a business. With accounts receivable financing, a lender agrees to purchase the business's outstanding invoices or receivables. In exchange, the lender provides an immediate infusion of cash to the business and assumes the risk of non-payment for the outstanding invoices. Because of the risk, the interest rates or fees associated with accounts receivable financing are usually higher than other forms of small business lending. SBA loans. The U.S. Small Business Association helps business owners acquire SBA loans through a large network of participating lenders. Generally, these loans of between $5,000 to $5.5 million are only available to business owners that have already exhausted their other loan options. If all of these prerequisites are met, the SBA loans can wind up to providing business owners with some of the best annual percentage rates on the market. Startup loans. A startup loan can help an entrepreneur scale up their business in many ways, like leasing office space, hiring employees, developing prototypes, or purchasing equipment. These loans take many forms, from SBA loans to business term loans to credit cards or lines of credit, but they're all tailored for startups. In addition to all of these options, a new loan option has popped up online in the past decade: crowdsourcing. A relatively recent innovation in the lending world, crowdsourcing gives both consumers and business owners the ability to make their case to the internet in hopes of getting a large quantity of microloans from people online who are moved by their story. In some cases, the money doesn't even have to be repaid. The crowdsourcing site usually takes a cut of the final amount raised, and the rest goes to the recipient. Other times, lenders will back a crowdsourcing campaign in exchange for a gift that the campaign designates for those who hit certain tiers. While this sounds great in theory, crowdsourcing is hardly a guarantee. Many campaigns have difficulty cutting through the noise of the thousands upon thousands of other pleas out there, elbowing into social media feeds trying to be heard. Also, depending on the site, certain campaigns are only funded if they meet a predetermined threshold, meaning that the borrower could put in all of the effort of building and marketing a campaign only to see it fall short of its goal and receive nothing. No matter which options you choose, loans come with undeniable risks. They also unlock the potential for unlimited rewards. With the proper planning and research, consumers and entrepreneurs can leverage their buying power through shrewd borrowing to achieve personal and professional advances that would otherwise be out of reach. Where forms the biggest database of legal documents. For more information about loans and for free loan form templates, check out the links in the description below this video.
Debt insurance plays a critical role in safeguarding borrowers against unexpected life events that may impact their ability to repay debts. By providing financial protection and ensuring continuity of debt payment during challenging circumstances, debt insurance promotes financial resilience and stability for individuals and families. What is the benefit? Debt insurance provides peace of mind for borrowers by covering outstanding debt in times of crisis, preventing financial strains on families, and protecting credit scores. It offers financial security and stability during challenging situations. Debt insurance typically covers a specific event outlined in the policy, such as disability, critical illness, or job loss. However, borrowers should fully review the terms and conditions to understand exclusions, waiting period, and claim procedures to mitigate potential risks.
Hi, this is Erica Sandberg, money expert, and today I'm going to be talking about credit insurance that you purchase on your credit card. So the point is, do you want credit card insurance or should you avoid it? In general, I'm going to say thumbs down, and here's why. First, figure out what credit card insurance is. It's a product that you purchase. Now, it's only a couple dollars typically, but it covers you under certain circumstances. You've got a couple of different types. So for example, you can have credit card insurance that covers you in the event of a disability and you can't work and you can't make your monthly payments as you should. In that case, you can protect your credit rating because maybe you certainly don't want to miss a couple of payments and then hurt your credit report or credit score. It also can help you if you lose your job entirely or if you die with a balance and you don't want to have your spouse or whoever is on the card responsible for that balance. Another type of credit insurance would be the kind that you would get to protect your purchases because maybe you buy something and you don't want it to come to you in a million different pieces, or if it gets stolen instead of arriving at your door, somebody takes it, and this is going to insure your purchases. So now, why do I say no for these type of insurance policies? Typically, it's because you're covered by something else. So for example, if you've got some sort of homeowner's insurance, if products don't arrive, then you're covered under that. But also, if they arrive in a million pieces, you're already protected with consumer protection laws because you can go back to the manufacturer, you go back to your credit card company and say, oh my gosh, this isn't as it should be, I shouldn't have to pay for it. So you're already protected, and it sort of protects you from that. Now, regarding other things like unemployment or disability or you die, well, you kind of don't need that either. First of all, you shouldn't be carrying a balance. Second of all, there are so many clauses that prevent these plans from paying out. And after being in the business for just about 20 years now, I have never once seen these insurance companies pay out. So you're probably spending a whole lot of money for a whole lot of nothing. Instead of purchasing another product on your credit card, try a different take. Set money aside into a savings account, and if you can't make your monthly payment because you're unemployed or you're disabled, you could tap into those savings. This is Erica Sandberg. Thanks for joining me.
But that's important topic. Bankruptcy reserves a legal mechanism for debt relief and financial restructuring in cases of insolvency. Understanding the types of bankruptcy, the procedural aspects, and the impact on debtors and creditors is essential for navigating through the complexities of bankruptcy process and planning for a successful financial recovery. So understand bankruptcy is legal process that individuals or businesses may seek when unable to repay debts. It provides a structured way to discharge debts, recognize finances, and obtain a fresh start. Bankruptcy laws vary by jurisdictions and determine the procedures for debt resolution. Types of bankruptcy. Bankruptcy include Chapter 7 is liquidation, Chapter 11 is reorganization, and Chapter 13 individual debt adjustment. Each type has specific eligibility criteria, processes, and implications for debtors and creditors, influencing the outcome of the bankruptcy proceedings. Process and implications. The bankruptcy process involves filing petition, asset evaluation, creditor meetings, debt discharge, and adherence to court approved repayment plans. Bankruptcy can have long consequences on credit scores, financial reputation, and access to credit, impacting individuals' financial ability post bankruptcy. Creditors' rights play a crucial role in debt collection process, granting creditors the legal authority to pursue debtors for repayment. By understanding the enforcement procedures and available legal remedies, creditors can effectively navigate debt recovery efforts and enforce their right within the bound of the law. Creditors' rights refer to the legal protections and remedies available to creditors to collect debts owed to them. These rights are established through contracts, laws, and court judgments, enable creditors to take actions to recover outstanding debts. Enforcement procedures. Creditors can enforce rights through various legal measures such as debt collection agencies, repossession of collateral, wage garnishment, and foreclosure. Understanding the enforcement procedure and compliance with relevant laws are essential for creditors seeking debt recovery. Loan default and remedies. Loan default poses challenges for both borrowers and lenders, requiring proactive measures to address default situations and mitigate financial risks. By understanding the cause of loan default, implementing remedial actions, and navigating the legal aspects of loan recovery, financial institutions can effectively manage default scenarios and protect their interests. Financial risk management is a critical function for financial institutions to proactively identify, assess, and mitigate potential risks that could adversely affect their operations and financial performance. By implementing robust risk assessment process and mitigation strategies, institutions can enhance their risk resilience, protect their assets, and sustain long-term viability. Banking regulations form the foundation of a well-regulated financial system, imposing standards and requirements to maintain integrity, transparency, and stability in the banking sector. Compliance with regulatory frameworks and staying abreast of recent development are crucial for financial institutions to navigate regulatory landscape, enhance management practices, and adapt to evolving industry needs. Case studies provide valuable insight into the practical application of bankruptcy laws, creditor-debtor relationship, and dispute resolution mechanisms in banking and financial domain. By analyzing real-world examples and resolution strategies, stakeholders can gain a deeper understanding of legal complexities, financial implications, and ethical considerations in banking operations. Consumer protections in banking. Consumer protection is paramount in ensuring a fair and transparent banking environment that prioritizes the interest of customers. Regulatory frameworks and oversight by government bodies play a crucial role in upholding consumer rights, fostering trust, and promoting ethical conduct within the financial service industry.
So we'll get going, guys. I apologize ahead of time for this session. We don't have a cool app to show you. We don't have some neat fintech to launch today or to put into the fintech. But hopefully we'll have an interesting session for all of you here today. Let me just take a couple of seconds just to introduce myself. I'm Richard Bilodeau. I'm the Director of Supervision and Promotion at the Financial Consumer Agency of Canada. At the agency, I oversee two things. On one end, I manage a program that supervises federally regulated financial entities that includes banks, among others. And I also oversee a promotion group that conducts research in emerging trends and issues, including fintech, as well as develop guidance for the industry. Prior to joining the FCAC, I spent 15 years at the Competition Bureau, managing a number of different investigations, both criminally and civilly.
Hi, I'm Sharitha Ellen, and I'm a lawyer at Norton Rose Fulbright, Canada. I specialize in financial services and regulatory matters for the payments industry. Financial services providers, including banks and many other entities that provide various types of services to their clients. Some of those touch on payments and some of them don't, and as we'll get into the details later, but what we're going to talk about is to the extent to which consumer protection regulates payments. So I was thinking in preparation for this conference and presentation, I would just bring my Payments Regulation Act and I would start reading it to you. And then you'd all know exactly how we regulate payments in Canada. But It's not so easy, and that's why we're here to talk about this topic. We can switch to the next slide. So before we really get into the idea of how we protect consumers and how Canadian laws, both federally and provincially, protect consumers that make payments, we put together this slide, which we're not going to go through in a lot of detail, and it's intended to be a busy slide. So we breached all the rules of making PowerPoints by making a very busy slide with not a lot of white space. But the point of it was to show you that we really have a very big landscape here. So there are many sources of funds. There are many methods of making payments. There are many different participants. I think that's our biggest category. There are many different participants that work in the payment space. And there are many reasons why consumers make payments. And in some respects, to the extent that any of these variables change, that affects the legal implications and the associated regulatory requirements with that payment. To some extent, that's good, and it should be. And as I'll argue or submit, in some cases, that's not good. So it shouldn't always matter, for example, who is the supplier of that payment. So the nature of the supplier shouldn't necessarily affect how the consumer is protected when they make that payment. As was put very well this morning, I thought consumers don't really care about payments. So we're at a payments conference. The people that we're talking about who are making those payments, they don't care about payments. They care about how they're getting their products and services. And the idea is that we have the least friction possible in the payment. There are also certain things that consumers will care about, and that we're going to ask you about in our next live poll, which I think is next. Yes. So we have a live poll. So since we're all consumers here, we thought that it would be nice to know what you think is the most important issue for consumer protection financial services. So I'm going to tell you how to use it, which you probably already know. So you go to your Payments Panorama app, you choose our topic in the agenda, and then you should see at the top, there's details activity polls, at least on my phone. But if you work at the FCAC, you don't get an option to vote on this poll, by the way.
We're not allowed to have opinions.
So it seems like you know how to use it. Oh, it says polling will begin soon. So I guess I'm not allowed to vote either. People are voting, so.
Seems like pretty even.
Seems like people are voting. I'm not allowed to vote. Maybe speakers are not allowed to have opinions either.
Well, well, we're not going to sit here and go through the vote.
Okay,
it's interesting that it's fairly well divided.
Okay, so in our presentation, I will question whether our laws appropriately protect consumers. We'll discuss how our laws apply depending on the method of payment that's chosen and the process that we use to make the payment. So I'll turn it over to Richard, who can describe what the Financial Agency, Consumer Agency of Canada, or as we know it as the FCAC, what their role is and how they govern consumer protection in financial services.
Thank you, Sharissa. Before I get going, just one little piece of guidance or a caveat. As I go through my presentation, I'm going to use a few different terms. Sometimes I'll use federally regulated financial entity. I might use banks. I might also refer to banks as FIRFIs. Those are sort of, they're not necessarily interchangeable technically speaking, but for today's purposes, consider them to mean the same thing, whatever I use. So let me turn on that to what the FCAC does. So the agency has a mandate to protect and inform Canadian financial services consumers. We protect consumers by supervising federally regulated financial entities to ensure that they meet their consumer protection provisions. We also inform consumers by developing resources aimed at increasing the financial literacy of Canadians by helping them develop the knowledge, the skills, and the confidence that they need to make informed, responsible financial decisions. One way that we do that at the agency is by developing consumer education material that helps consumers and merchants understand their rights and responsibilities. Some of you may have seen we launched videos earlier this year, and I think we also launched one or two last week. We launched a video on PIN protection. So we have a character that we call Floyd, and he's used to, it's a little bit haphazard, but he's used to show that consumers have responsibilities when they use their PINs, for example, but also protecting their PINs and to ensure that there's no fraud on their card. So we use material like that to educate consumers on what they need to know when they make financial decisions and when they use financial services. When it comes to supervision, the FCAC monitors compliance of FERFIs with consumer legislative provisions, voluntary codes of conduct, as well as public commitments that are meant to protect consumers. On the banking side, the FERFIs we do supervise include banks. You all know who they are. Insurance companies to a certain extent, as well as external complaint bodies, who are bodies that have been set up to deal with complaints that are sent to banks and that may not be resolved at that first level at the bank. In addition to that, we also, so when it comes to banks, we ensure they comply with the Bank Act primarily. We also supervise payment card network operators to ensure compliance with the Code of Conduct, and I'll speak a little bit about the Code of Conduct for the credit and debit card industry in Canada a little bit later on. Let me spend just a quick minute on our approach to supervision, since that's where I'm from. It relies on three pillars: promote, monitor, and enforce. First, when it comes to promotion, we believe that compliance is facilitated when obligations are clearly identified to FIs and accessible to regulated entities. So as an example of this, in the past, to make sure that FIs know what we expect of them, we've published decisions from the commissioner when there has been a breach of, so when there's a breach of a provision, commissioner will typically, when it goes to that stage, publish a decision that's anonymized typically and put up on our website to provide guidance. We'll also issue interpretive guidances on the provisions that we enforce. I'll give you a couple of examples of those a little later on. Second, we proactively monitor regulated entities to determine whether they're complying with their obligations. Those that work in compliance and FIs know that they have to report complaints that they get or compliance issues that they identify as they carry on business. We also gather information on current and emerging issues and risks in the financial sector. And finally, when there is a breach of one of the provisions that we enforce, or a public commitment or a voluntary code, we will investigate that breach and we'll take appropriate action where we think that we need to respond to ensure compliance and deter future non-compliance. So these three pillars are the foundation of what we're developing now. So we're developing a revised supervision framework. We expect to have that out for consultation over the next few months, and we invite all of you to comment on that when the time comes.
Now I'm going to take a little different tack here and just talk about the types of regulation. So we're talking about regulating the provision of financial services and payments, and specifically how do we address consumer protection. But we've divided the types of regulations into the 4 categories you see on the slide. So what we have in Canada, unfortunately for the businesses in the room, we don't have a Payments Regulation Act, as I said, that very neatly ties up all of your obligations when you're dealing with consumers. And what we do have is a patchwork of laws that address different aspects of the financial services and payment systems. And I would say that that's because of the history and the legacy of those laws. So when many of these laws were drafted, the legislators didn't know exactly how they would be used today in 2016. And as we know, the pace of change is very slow. I think it would be fair to categorize our various laws, in addition to the 4 categories that we have on the slide. I think it would be also fair to categorize our laws for financial services into 2 basic categories. One is prudential regulation, and the other one is consumer protection. And then some might say, can add a 3rd category of laws that actually have 0 purpose and we don't understand what they're for. But in theory, the 2 categories would apply. And I would say that consumer protection is not always, can be in conflict with prudential regulation, and that is the reason for the existence of the, or at least the original reason for the existence of the FCAC. So originally we had OSFI was the federal regulator of banks, and it was responsible for both prudential regulation and consumer protection. The FCAC was created to address that potential conflict between prudential regulation and consumer protection. So we have entity-based laws, that means laws that apply because of who you are. So what kind of institution are you? Therefore, the law will apply. And a very good example of this is the laws that the FCAC enforces, such as the Bank Act, the Trust and Loan Companies Act. These are federal regulations, federal statutes and associated regulations. We have some examples of this in the provincial sphere. One example would be credit union legislation. So that applies specifically to credit unions. And those are essentially, I call them membership driven. So you apply to become a bank, you become licensed as a bank, or you receive your order to operate as a bank, and you are then subject to the Bank Act. And then we have laws that are based, and I would also add that within your institutional-based regulation, you do have specific laws that apply depending on the product or service that you're offering. So for example, if you are a bank, then you're subject to the Bank Act, you're subject to many provisions within the Bank Act that deal with being a bank, but you're also subject to specific rules that apply when you are a bank and you issue a credit card to an individual. Then you have laws. So my second category, you have activity-based laws. So activity or product-based. So theoretically, that kind of law it doesn't matter who you are. It just matters what you're doing. So we see more of that in the provincial space. So in the provincial space, we have consumer protection legislation, which covers the various activities that are being conducted. And it doesn't matter what kind of institution you are. If you are, again, using lending as an example, because it's heavily covered in consumer protection, if you are providing a loan to a consumer, then you are subject to the consumer protection requirements dealing with the loans. So the functional approach, so that's when I talk about entity-based versus activity-based, the functional approach, if you might hear that term used, that's when you say, what is the supplier doing? And then that's how we should regulate. So that aligns with the activity-based law. So it focuses more on what you're doing rather than on who you are. Then we also find laws in the provincial space that address the channel in which you're providing your products or services. And I would argue that potentially those kind of laws are not preferable anymore. So one example of channel-based laws are laws that address disclosures in an internet agreement. So we have those in a number of our provinces. I would argue that those are somewhat outdated and should probably be revisited, because most businesses are now operating in many channels, and it shouldn't be considered an area that's particularly deserving of consumer protection just because you are dealing with your customer via the internet rather than dealing with them in your bricks and mortar store or in your bricks and mortar branch. Then finally, we have laws of general application. So that's things like, in the federal space, that's things like the Competition Act, which deals with misleading advertising and deceptive marketing. We also have very similar provisions provincially, which deal with unconscionable transactions. There's misleading representations in the provincial consumer protection legislation. And I can sum that up somewhat cynically as the laws that say treat your customers fairly. So that's a law that I would say overrides all of these. So above all, you have all the specific requirements dealing with your product and dealing with who you are and what you're doing. And in addition, you have these overarching rules. So even if let's say you take the view that certain provisions, specific provisions don't apply because of what you're doing, you still need to go look at whether ultimately what you're doing, you've provided clear disclosures, you've explained clearly to your customer what it is that you're doing, what the terms and conditions are, and what fees will apply. So I think that's where we could look at the general provisions.
So earlier, I'm going to spend the next couple of slides just talking about some of the legislation and the requirements that are imposed on FIR fees. I won't go into detail on every single one of them because it would be a lot longer than this short panel. But let me get into detail what those compliance obligations are. And because this is a payments conference, I'll focus a little bit more on, or primarily on, the obligations that apply to products in the payment space. So let me start off with the cost of borrowing regulation. So The Bank Act, again, general piece of legislation that applies to FERFIs. It has a number, I think it's 26 or 27 pieces of regulation that apply to a variety of things. Cost of borrowing regulations are one of the key ones. It applies to a number of credit agreements, whether it's loans or credit cards. And what it basically says is that basically requires that FERFIs give consumers prescribed information, such as things like applicable interest rate on an outstanding balance on a credit card, information on liability for that credit card, and a credit limit, in language that's clear and presented in a manner that's not misleading to the consumer. And when it comes to credit cards, the credit card issuer, so the FERFI, must provide the information to the customer or with the application and the credit card agreement. And the information, I know if you've seen your recent credit card agreement or application, it usually comes with a piece of paper that has a number of boxes on it and information. That information is prescribed by the cost of borrowing regulations, and those are what we refer to as information boxes. Another piece of regulation that applies in the payment space are basically the prepaid payment product regulations. So when it comes to prepaid products, consumers must be provided with key information related to prepaid cards and other prepaid products. It's important to note that these regulations apply only to federally regulated financial entities and don't apply to prepaid products that are provincially regulated, that are issued by provincially regulated institutions or retailers. And some of those requirements. So first thing I'll mention, I think it came up this morning in this room on a panel that Jacqueline was talking about expiry dates. So FERFIs that issue prepaid cards or products cannot set an expiry date on the funds that are loaded onto them. This requirement, however, doesn't apply to promotional or loyalty products distributed by a company as part of a promotional or some sort of award program. Before issuing the card, there's also certain information that must be provided, including the name of the issuing institution, if fees apply to the card, and usually there are, information about fund expiry dates for promotional or loyalty cards. As well, when it comes to fees, another important piece here is that they have to be included in information boxes on the outside of the packaging of the prepaid card. So not only in that piece of paper that comes in when you open the package, they have to be on the outside of the package so that consumers know what they're getting into when they're buying a prepaid card. So in addition to that, once the prepaid card is issued, the cardholder must also be informed on the conditions of use of that card or the product, including the consumer's rights and responsibilities, as well as what to do if the card is lost or stolen. Now, there's a number of things that institutions are not allowed to do. For example, they can't increase fees or introduce new fees unless the cardholder has provided the institution their name and mailing or email addresses, and the bank has disclosed the new or the increased fee at least 30 days before it comes into force, and at least 60 days on their website prior to that. They can also charge maintenance fees for at least 1 year after the prepaid card is issued or activated, but that doesn't apply if the card is a promotional product or if it's a reloadable card and the consumer has given express consent to be charged maintenance fees. So those two conditions have to be present. And also, banks cannot charge overdraft fees or interest for prepaid cards or products unless the cardholder has given express consent. Next, credit business practices. The one thing I'll talk about here is that these regulations require FERFIs to obtain express consent from borrowers prior to increasing their credit card limits, as well as before providing them with credit card checks. And one small little aside on checks. I know it came up today and we're a little bit laughing about checks, just on access to funds, because checks are still used as a payment mechanism for people, for certain individuals. When you are depositing a check, you have to make the first one. FERFIs have to make the first $100 available for withdrawal. Moving on, so in addition to these regulatory requirements, I mentioned earlier that the agency often publishes guidance to help FERFIs comply with the legislative requirements. We have a few of them. I think we're up to, we just released, I think, guidance 16 today or tomorrow. I'll talk about that in a second, but we have a few of them. Number one is on clear language. So I did speak earlier about clear language, and we have issued guidance about how we expect FERFIs to go about making sure that their communication is provided in clear language. So we expect institutions to effectively demonstrate that it's applied the 5 principles of clear language outlined in the guidance. And those 5 principles are as follows. 1, know your audience. Number 2, make your material understandable by planning the text. Write clearly. Use the visual presentations to enhance the text. And finally, test your material. And I'll just say a quick note on this. The agency right now is conducting what we call it internally as a clear language review. We're reviewing credit card agreements, credit card disclosure to determine readability and how clear it is for consumers to understand the material, and we'll make those findings available probably early 2017 at the earliest. But it's an interesting piece of work, and you realize that despite a lot of work that's gone into making them clear, they're still not the easiest thing to understand. Another piece of guidance that's important is the internal dispute resolution guidance. That's guidance number 12. So all FERFIs are required by legislation to have dedicated procedures as well as personnel in place to deal with consumer complaints. What CG12 does, it assists FERFIs in developing their internal dispute resolution policies and procedures to comply with the legislation. And again, we have guiding principles here in this guidance to help FERFIs. There are 3 of them. And the first one is effectiveness. So there must be organizational commitment, adequate resources, training for staff, and monitoring and reporting systems. The second is efficiency. There must be timeliness to internal dispute resolution and in working with the external complaint body. And finally, the final principle is accountability. Again, here the bank's complaint handling procedures must be easily accessible to consumers and straightforward to understand. So it has to be easy for the consumer to bring up an issue with the bank. And of course, the policies and procedures have to be transparent. And one way that has to be done is that the policies have to be available on demand and also on the bank's website. I mentioned, we talked a little bit about the code, and I'll get into that a little bit more in just a second. When the code was amended back in April of 2015, we started developing a number of 2 guidances and updating a 3rd one to help merchants, acquirers, and other code participants comply with the new requirements in the code, specifically around disclosure and information boxes that have to be provided in the agreements. Those requirements, so when the Code of Conduct was released in April 2015, there were a number of dates that were set out for implementation. The final date's November 13th to make sure that those information boxes are with the agreements. We had developed guidance to help people, as I said. We were aiming to get those released in May, a little bit delayed in getting that out. But if it hasn't been done already today, we'll be sending out informally the guidances tomorrow or Friday so that payment card network operators and acquirers can get going on complying with that code requirement. On the Code of Conduct for the credit and debit card industry in Canada, it's an important tool that governs conduct in the payment card industry. As it came out initially in 2010 and amended in 2015. It applies to, all of the PCNOs the payment card network operators have signed on to it. Payment card network operators are also responsible for ensuring compliance of code participants, so the people that are downstream of them with ensuring compliance with the code. And the FCAC is responsible for monitoring that. So just a quick word on that. I know we're running quick today, but relevant to this group here, we get asked oftentimes a lot of questions about the code. They're mostly written as they're not as prescriptive as regulation. We're often asked to interpret what this provision of the code means to this particular type of product. And when it comes to that, we do try to balance the intent of the code, what the words of the code say, but also try to balance innovation and make sure that at the same time are protected, that businesses can launch new products and consumers can benefit from them. It's not always an easy exercise, but we try to carry out that balance as best we can. Another code of conduct that we administer very quickly is the Code of Practice for Consumer Debit Card Services. It has a number of requirements in there. Well, among them, it deals with fraud and liability coverage as well. And finally, just on a public commitment that we do administer as well, is the zero liability on credit.
Key learning of today is we have reflected from this presentation that stakeholders can gain valuable insights into aspects of banking, creditors' right, and financial management. Understanding consumer protection laws, debt recovery processes, and risk management strategies is essential for informed decision making and regulatory compliance. And that frameworks to awareness and for in and safety in practices. Each trend and knowledges anticipating future trends and security threat is and adapt measures regulatory changes improve for really dynamic and inclusive. Insurance and best practice of regulatory development trends stakeholders can these just sustainability hold better and available to you to want to check. That's all for today.